Okay, we'll pick up with problem 6 here. And this is, again, pretty straightforward. They just want you to calculate the after-tax cash flow. So the only thing you got to remember here is to deduct depreciation before computing taxes. But then, since they want cash flow, you don't subtract depreciation from the cash flow. So let's just look at it real quick. 100 minus 30 fixed costs minus 50 variable costs. So that's 80. So you got 20 pre-tax income. And here's where you subtract the depreciation to give you $10 after-tax income times the 30% tax rate. So you got $3 in taxes. Now you're ignoring the depreciation for purposes of cash flow. So 20 minus 3, the tax is 17 cash flow. So that looks pretty good to me. Okay, looking at problem 7 here. So the result, what they want is increase or decrease in working capital for year 5. So the trick here is just recognize what goes on the asset side and what goes on the liability side. So inventories, for project Z, year 5 inventories. Okay, year 5, so that's consistent. Inventories is an asset, so that's 6 increases by 6,000. Your working capital. Accounts receivable is also an asset. So on the asset side of the working capital calculation, you've got a $10,000 increase. I'm putting the plus signs here just to indicate it's a change, not an absolute number. Accounts payable is on the payable side, so that's increase, but it's on the liability side. So the net working capital is changed by has increased by 7,000, which would indicate none of the above. Let's see if inventories increased by 6. That's an asset. Receivables increased by 4. 6 plus 4 is 10. And accounts receivable increases by 3. So 10 minus 3 is 7. And it's an increase. So I know it's neither of these. So yeah, I think it's none of the above, but maybe I missed something there. Okay, so this one's a really interesting, and if you ever run a small business, very practical problem, because normally when we talk about sales, when people refer to sales, they're talking about accrual accounting sales. So that's not collections. And if you're running a small business and don't have gobs and gobs of unlimited extra cash, cash is oxygen for any business, and a small business sometimes has lesser margins of extra oxygen in the form of cash. So it becomes really critical that you know what your cash flow is, monthly or weekly. That's really much more important than knowing what your sales are. So let's just take this through. So receivables at the end of December were $24. What are forecasted collections on accounts receivable in March? Okay, so 60% of the VL sales usually paid for in the month that they take place, 40 in the following month. So the December sales, that should all be collected by March, so that number is irrelevant. And January sales are really irrelevant too, because they should have all 60% been collected in January and 40% in February. So for the only two numbers here that are really irrelevant are February and March. So 60% are usually paid for in the month they take place. 60%, $60 times 60% times the $100 in March sales. So 60 of the $100 in accrual accounting sales would be collected in March, and then in February 60% was collected in February, but 40% is remaining to be collected in March. So that's 32. So I get 92 million. Okay, I think that's all the questions for the practice test. I hope it's really this easy. I hope your final's really this easy. Okay, bye.